Welcome back to The Explainer. So today we've got a really fascinating financial mystery to unpack. We're running a full analysis on Gibson Energy, and we're trying to answer one big question. Is that 6% yield a hidden bargain, or is it a massive leverage trap? I mean, if you're an income-seeking investor, a yield like that is super tempting, right? But as you're going to see, it comes with a pretty serious catch. Let's get right into it. Okay, let's dive into this, because this right here is the tension that defines our whole investigation. On one hand, you're looking at a super alluring 6.33% forward dividend yield. Into those market, absolutely fantastic income stream. But flip that coin over, and we're staring down a pretty terrifying debt-to-equity ratio of over 280%, plus a payout ratio over 195%. So you have this huge attractive yield pulling you in, and this heavy, heavy financial leverage pushing you away. This is exactly what we need to figure out today. Quick look at our roadmap for today. We're going to cover the summary and intrinsic value, do a deep dive fundamental analysis, run through a weighted SWOT analysis, map out some scenarios and price targets, score the risks and opportunities, and then we'll wrap it all up with a final verdict. All right, phase one, summary and intrinsic value. Let's figure out what they actually do and what the company's inherently worth. So, Gibson Energy. They're a Canadian energy infrastructure company. And the key here is they aren't out there directly drilling for oil, which, wildly exposes you to commodity price swings. Instead, Gibson operates a lot more like a toll collector. They own the storage terminals, the pipelines, the rail facilities moving the oil. It's basically a toll road business model for North American energy. Now, while that gives them wonderful stability and really reliable dividends, they also have this marketing segment that trades hydrocarbons. And sure, that creates massive revenue on paper. We're talking over 10 billion Canadian dollars, but the actual profit margins are incredibly thin. It's kind of like passing a giant bucket of money around a room just to keep the loose change at the bottom. Now, what's really interesting about this is the disconnect between intrinsic value and what the market's actually paying. Look at the discounted cash flow, the present value of their future cash. That gives us a really conservative value of $24.50 CAD. The multiple of enterprise value, or MEV, is sitting at $26.80. Average those out, and our blended intrinsic value is $25.65. But check out the current share price. It's actively trading at a premium right now, up at $28.05. The market is clearly super willing to pay extra for those stable infrastructure cash flows and that high dividend. But the big question is that premium actually justified? To figure that out, let's jump into Section 2, Deep Dive Fundamental Analysis, and look for some clues. Let's start with their economic moat. I'd call it moderate. Gibson's physical assets, like these massive tanks and terminals, are ridiculously expensive and really difficult to replicate. Add in regulatory barriers and their strategic locations near refining hubs, and well, a new competitor can't exactly just show up and steal their lunch. That said, the moat is definitely narrower compared to giant pipeline operators like Enbridge or TC Energy. Gibson just doesn't have those dominant continent-wide network effects. When we break down profitability and the balance sheet, things get a little complicated. Revenue is very stable, but that net margin, a razor-thin 1.4%. Now, on the surface, their return on equity looks amazing at 15.13%. But hold on, you gotta be careful here. That number is artificially inflated by leverage. They are carrying a net debt of 2.65 billion Canadian dollars, which is 4.6 times their EBITDA. For a mature infrastructure business, that is highly elevated. Management is competent, sure. They've avoided reckless acquisitions, but this high debt combined with very modest tangible equity means your downside protection is pretty limited if interest rates stay high or the energy sector takes a hit. And that brings us to the biggest, most alarming fundamental clue of the day. 195%. That's Gibson Energy's payout ratio. Literally, the dividends they are paying out to shareholders are wildly outpacing the reported net income. Now, I know midstream companies usually want you to look at distributable cash flow rather than net income to justify the dividend, but still, a payout ratio hovering near 200%, that is a massive, flashing red warning sign. The actual cash left over after paying debt obligations is weakening, which means sustaining this massive dividend relies heavily on them just constantly borrowing more money. Okay, moving on to Section 3, Weighted SWOT Analysis. Let's see how all these pieces fit together. It all comes down to how these opposing forces balance out. We gave their strong, hard-to-replicate infrastructure assets a solid 8 out of 10. The high dividend yield also scores an 8 out of 10 because honestly, it is a genuinely attractive income profile. But look down below that. The high leverage and major financial risks pull a concerning 4 out of 10, and their vulnerability to interest rate exposure is also a 4 out of 10. When you weight the whole shebang together, the overall score is a very mediocre 6.2 out of 10. Basically, those strong physical assets are barely edging out the heavy financial burdens. Knowing those risks, let's step into Section 4, Scenarios and Price Targets. Time to run the simulations and see what price actually makes Gibson Energy a smart buy. We ran 3 different simulations based on the source material. In our bear case, which would be driven by prolonged elevated interest rates, refinancing pressure, and dividend stress, the valuation drops down to 18 Canadian dollars. Our base case, assuming stable infrastructure utilization and continued dividend support, lands right exactly at our blended intrinsic value of 25.65. And then in the bull case, where interest rates actually drop and investor appetite for high-yield equities comes roaring back, the valuation expands up to 34. So what does this actually mean for your returns over, say, a 16-year horizon? Well, if you buy right now at the current market price of around $28, you're only looking at a 6% annual return. If your investment goal is to hit a much stronger 9% annual return, this stock is just too expensive right now. You'd literally need the price to drop significantly, down to a maximum buy price of 20 Canadian dollars, just to lock in that 9% target. And this brilliantly illustrates how your investment time horizon dictates the price you should be willing to pay. We're keeping our target fixed at a 9% return for this. If you have a short 5-year horizon, okay, you could maybe justify buying in at $24. But if you're a long-term investor looking 14 to 16 years out, you demand a much larger margin of safety, right? So your maximum buy price tightens all the way down to $20. Before we wrap up the case, let's look at Section 5, Risk and Opportunity Scores. When we aggregate everything, financial stability, earnings volatility, growth potential, competitive advantage, look at how these 2 metrics are sitting almost dead even. The risk score is a 5.8 out of 10. That means it's substantially safer than direct commodity producers, but for sure a lot riskier than a conservatively financed utility. And the opportunity score? 5.7 out of 10. Meaning your returns here are primarily going to come from those dividends, not some explosive capital appreciation. It's just a perfect visual confirmation of how truly moderate disinvestment is. All right, time to synthesize all our clues in Section 6, Final Verdict and Takeaways. Here is our final takeaway. Gibson Energy is a hold. They're a perfectly competent infrastructure operator, but at current prices, the stock is trading above conservative intrinsic value, and it simply lacks a margin of safety. Between the really high leverage, that super aggressive payout ratio, and the sensitivity to interest rates, you just aren't being compensated enough for the risk at $28. Now, it's a solid hold if you're already in it and collecting that income, but the most rational strategy for new capital is just patience. Wait for a cyclical drop, or maybe an interest rate-driven sell-off to push the price down into the $18 to $22 range. That is your strong buy range, where you can aggressively accumulate shares with a proper buffer. And that wraps up our explainer on Gibson Energy. I really hope the breakdown today helped you spot the difference between an alluring yield and a hidden leverage trap. Kind of leaves us with a critical question for your own portfolio, right? Is chasing an extra percentage point of yield ever really worth losing sleep over a mountain of corporate debt? Let me know your thoughts. Also, I want to hear from you. Which stock should I analyze next? Drop your requests down in the comments below. Thanks so much for hanging out and learning with me today, and I'll catch you in the next explainer.